Polymarket traders are pricing Meta's layoff wave before workers even reach the May 20 cut date. The Polymarket AI story is not simply that artificial intelligence is replacing people. It is that prediction markets are turning the job cut narrative into a tradable signal, while the companies building AI tools keep hiring. Meta is preparing to eliminate roughly 8,000 positions, about 10% of its 79,000-person workforce. At the same time, OpenAI plans to grow from about 4,500 workers to 8,000 by the end of 2026. That split is the tension. Older platform companies are trying to cut layers, reduce support teams, and prove that AI spending can translate into efficiency. AI-native companies are expanding headcount in product, engineering, research, and sales because they need people to build, sell, and control the systems causing the disruption. So the question is not whether AI removes every job. The better question is where the work moves. Some roles disappear from one part of tech, while new roles concentrate around the companies that own the models and infrastructure. That concentration can make the labor market look contradictory. The same AI cycle can remove one support role, create a model evaluation role, and increase demand for people who can sell AI products to enterprises. Prediction markets are making that tension visible. Polymarket traders put about $112,000 into markets tracking Meta's employee count and stock price. A broader tech layoff market sat near 79% odds for increases through the month. Kalshi's competing market crossed $30 million in bets. Those numbers do not prove traders are right. They show that layoffs are no longer only an HR event or an earnings footnote issue. They are becoming market data that people price before management delivers the official schedule. The market reaction adds another layer. Meta shares rose roughly 3% when the layoff news first leaked, and a separate market gave high odds for shares clearing $700 in April. Bank of America's projected savings were listed in the $7 to $8 billion range for the restructuring, with an $885 price target. That is why workers can see a painful job cut while traders see margin improvement. The same event can look like a human cost on one screen and an earnings lever on another. For a public company, that margin story can arrive faster than the worker story. Savings are modeled in spreadsheets before anyone can prove whether the smaller organization actually produces more with less. The weak point in the AI efficiency argument is measurement. A Duke and Federal Reserve Bank's survey of more than 750 chief financial officers found over 80% reporting zero productivity gains from AI, even while the same survey projected roughly 502,000 AI-related job cuts in 2026. That gap matters. If companies cut first and productivity fails to appear, the story shifts from smart automation to cost pressure dressed up as technology. Polymarket AI odds can move quickly, but odds are not proof of business performance. That is why the productivity data is the pressure point. Cutting headcount is visible immediately, while the operational benefit may take quarters to confirm. The next signal is Meta's first quarter earnings on April 29, followed by the May 20 layoff wave. Those dates will show whether executives can connect AI spending, headcount cuts, and actual productivity in a way markets can verify. For workers, the risk is job concentration around fewer AI platform companies. For traders, the risk is treating cuts as automatic profit. The Polymarket AI setup is useful because it exposes the conflict early. Layoffs are being priced before the productivity story has been proven.